Have you ever wondered why the rich seem to pay less tax than you do? It's a question that has crossed many minds and sparked countless debates. The answer, however, isn't as straightforward as you might think. We often perceive that the wealthy, with their high income and lavish lifestyle, would be paying more taxes. But the reality can be quite different. This isn't necessarily because they're bending the rules, but because they're playing a different game. They have access to a range of tax-saving strategies that can significantly reduce their tax burden. These strategies, which can involve everything from savvy investments to strategic philanthropy, are often perfectly legal and can be used by anyone. However, they require a nuanced understanding of the tax code, a willingness to plan ahead, and sometimes the guidance of tax professionals. So, intrigued yet? Let's dive into the world of tax-saving strategies and understand how they work. One of the most popular ways the wealthy save on taxes is by using tax havens. A tax haven is essentially a country or a jurisdiction that offers low tax rates or even no taxes at all to foreign individuals and businesses. This is done primarily to attract overseas wealth. Some of the most well-known tax havens include the Cayman Islands, Bermuda, and Switzerland. But why are these tax havens so appealing to the wealthy, you may ask? Well, the answer is quite straightforward. Wealthy individuals and corporations use tax havens to reduce their tax liabilities. In simpler terms, they use these havens to pay less in taxes. This is achieved through various legal and financial strategies. For instance, a corporation might shift its profits to a subsidiary in a tax haven to avoid paying higher taxes in its home country. Now, it's worth noting that while using a tax haven is generally legal, it's a practice that's often seen as controversial. This is due to the fact that it contributes to income inequality and can deprive governments of much-needed revenue. So, why do tax havens continue to exist, despite the controversy? The answer lies in the global competition for capital. Countries and jurisdictions that become tax havens can attract significant foreign investment, which can lead to economic growth and job creation. However, it's not all sunshine and rainbows. The use of tax havens can also lead to economic instability, as it can create a dependence on foreign investment. Moreover, it can promote a race to the bottom, where countries continuously lower their tax rates to attract foreign capital, which can lead to a decrease in public services. In conclusion, tax havens are a complex and controversial issue. They offer significant tax savings for the wealthy and can stimulate economic growth, but they also have serious drawbacks. While tax havens may be out of reach for most of us, there are other tax-saving strategies that can be employed. Another savvy way the rich save on taxes is by managing their capital gains and losses. Now let's break this down. Capital gains are the profits you make from selling an asset like stocks, real estate, or a business, and they are subject to tax. However, the tax rate on long-term capital gains, those on assets held for over a year, is generally lower than the tax on ordinary income. So, here's a trick that the wealthy often use. They hold on to their assets for at least a year and a day before selling, thereby qualifying for the lower long-term capital gains tax rate. Smart, isn't it? But what about capital losses? Well, these are the losses incurred from selling an asset for less than its purchase price. The rich use these losses to offset their capital gains, reducing their overall tax liability. This strategy is known as tax loss harvesting. In essence, the wealthy are playing a balancing act. They time their asset sales to maximize profits and minimize taxes, while also leveraging losses to offset gains. It's a game of patience, strategy, and a keen understanding of tax laws. Capital gains and losses may seem complex, but they offer substantial tax-saving potential. So while it might sound like a lot to take in, understanding these concepts could help you save a sizable chunk on your taxes. And who wouldn't want that? Trusts and estates are another tool in the rich's tax-saving arsenal. Let's delve into the concept of trusts first. A trust is a legal agreement where one party, known as the truster, transfers assets to another party, the trustee, to hold on behalf of a third party, the beneficiary. Trusts can be designed in various ways and can specify exactly how and when the assets pass to the beneficiaries. They are popular among the wealthy because they offer control over assets even after death, protect against lawsuits and creditors, and yes, they help reduce estate and gift taxes. Now let's talk about estates. An estate is the total property, real and personal, owned by an individual prior to distribution through a trust or will. When a person dies, their real and personal property becomes part of their estate. Estate planning, which can include drafting a will, setting up trusts, establishing a power of attorney and more, is a key strategy the wealthy use to minimize taxes and ensure their wealth is transferred according to their wishes. One common type of trust used in estate planning is the revocable living trust. It allows the trustor to change or cancel the trust during their lifetime and possibly avoid probate. There are also irrevocable trusts, which can't be changed or terminated without the permission of the beneficiary, offering even stronger protection against creditors and lawsuits. Trusts and estates may not be for everyone, but they have proven effective for many. So how exactly do the rich save on taxes? Well, we've explored a plethora of strategies, but let's take a moment to recap and connect the dots. Firstly, we delved into tax havens. These are countries or states with very low or even non-existent tax rates. By establishing businesses or trusts in these places, the wealthy can dramatically cut down their tax bills. The Cayman Islands, Bermuda, and even some US states like Nevada and Delaware are often used as tax havens. Next, we ventured into the realm of capital gains and losses. By timing when they sell assets, the rich can control when and how much they pay in capital gains tax. If they have a bad year where they lose money on their investments, they can sell off some assets to realize a capital loss, offsetting other gains and reducing taxable income. Our journey then took us to the world of trusts and estates. The wealthy often transfer wealth to trusts, which can be structured in ways that minimize taxes. These trusts can generate income that is taxed at a lower rate, or even avoid estate and gift taxes on wealth transfers. But here's the clincher. These strategies aren't used in isolation. The savvy and the wealthy often use a combination of these methods to optimize their tax savings. They might establish a trust in a tax haven, generating income that's taxed at a lower rate. They might time their capital gains and losses to coincide with changes in trust income, further reducing their tax bill. While these strategies may seem out of reach, understanding how the rich save on taxes can help us make more informed financial decisions. It's not about evading taxes, but about understanding the system and using it to your advantage. It's about making the tax code work for you, rather than against you. And remember, knowledge is power. The more you know about tax strategies, the better you can navigate your own financial journey. So keep exploring, keep learning, and keep striving for financial success. While these strategies may seem out of reach, understanding how the rich save on taxes can help us make more informed financial decisions.